Okay, I'll upload that in course, or maybe I'll upload that on YouTube in a private video section, and I'll share you that link. So other people, they won't be able to access it. Okay. So see this is, let's say, it's a graph that represent price, and let's say time, I would say. Okay, or else vice versa. So time or price, right? Always price starts from the zero, correct?
Yes.
So this is your market graph. It's a simple, it's a upward trend, right? Upward trend, it means price, let's say 10, 20, 30, 40, 50, 60, 70, and so on. And here that you can say instead time, set your purchase price. So this is becomes your market price. Market price. And here you can say your purchase price or spot price. So now let's say XYZ security, let's say GMT security. GMT security. GMT is a listed security. It's not a listed in reality, but for example, I'm just giving you the reference. Okay. GMT security is a listed security, and the price of GMT security is at this. $20. So here you are at, and you're thinking about, so see, you have done some sort of research. You got to know where the price of GMT security may go up in upcoming time, maybe let's say week or 2 weeks or 3 weeks duration. So you have done solid research, and on the basis of that, you are very optimistic about GMT price, means upward trend, right? Upward trend. So you will have two options. One, if you have a cash, you can buy and hold it, right?
Yes.
Why? Because you have done solid research and you know it price will go up. Price go up. The other important aspect is, if you don't have a fully cash, let's say your target is to buy 10 lakh worth of rupees 10 lakh securities, right? 10 lakh. But you don't have a 10 lakh cash. Then what would be the other suitable option? You don't have a 10 lakh rupees cash, but your target is to buy the securities worth of rupees 10 lakh. The other way is like, if you don't have a 10 lakh, other way is like to pay the premium, which is 10% of 10 lakh, that comes around 1 lakh, to pay the 1 lakh and to hold the contract value of 10 lakh, right? To hold the contract worth of rupees 10 lakh by paying only advance amount. Let's take the practical example, routine life example, daily life example. You paid 1,500 to me as an advance, right? So you wanted to optimization, and that's what you paid, only 1,500. So you can relate that 1,500, it means you paid premium,
Yes.
and rest amount you can pay at the time of settlement. Correct?
Yes.
So in a
Yes.
contract also, in an option contract also, to hold rights, it means I'm holding rights. I'm holding rights of buy. I'm holding rights of sell. But what it is, what it means, I'm holding the rights of this value, 10 lakhs value. So I can buy anytime, I can sell anytime. Because buyer, if you sell or if you buy, buyer it means, or customer, I can say, customer is the king of market. Customer has no obligations. Same rule you can apply in option market also. Option investor has no obligation. I'm not talking about writer, I'm talking about holder.
Yeah.
Option holder has no obligation, no even restrictions to buy any option at any point in time. As simple as that. So it means if you want the exposure of 10 lakh, so you can pay 1 lakh and then hold the options. So that option you can call it as a call option. Why call option? Because price will go up.
Yes.
And if the price, let's say you have purchased here option, call European you have purchased here, and that price goes around here, let's assume it. You see the profit and your option, your price would be around 60 minus 20, 44 per unit, 44 per unit. Let's say in one lot there are 100 units, right? In one lot there are 100 units. 100 into 40, it goes around 4,000. So profit would be 4,000. This is the one side. So think about other side. You purchase it, it means someone would have sold it, correct?
Yes.
Against you, and that's what you would have purchased that particular option. If there is no seller, then you cannot purchase. Then
Yes.
who paid this 4,000 profit to you? Of course, someone who have sold the option here, same counterparty will do some research, and let's say they had input, price may drop in future. But that's not happened here. So price went up, and now you are in a profit. The person who sold that particular option, sold it means in this case against you, there would be writer who write this particular option, right? Because
Yes.
you paid premium around 2,000, so you paid premium to the writer, option writer. When you paid premium, that premium received to the option writer. And here in this case, you have earned profit. It means writer will bear your entire profit, whatever profit that you have received. So now, if someone write the option, so it means he or she has an expectation of price drop or price decline, decrease or down. Are you getting me?
Yeah.
If anyone means against the call option, if someone write it or someone sell it, so just give me a moment. I'll share you my screen and I'll show you there only. Because to explain theoretically and show you again, that's difficult, but to explain quickly. So if I take the example of, let's say, Bank Nifty, see this is the Bank Nifty, 1st of June. So today is 31st, right? And we have a 31st of June. So it means Bank Nifty. If I purchase the Bank Nifty, same call option. If I purchase it, this option, that becomes option buying for me, right? If I purchase it, that becomes option buying for me. But if I sell it out, this one,
Yes.
then that becomes option
Yes.
writing for me. With the same option, if you see, option writer has an expectation where price will go down in future. And if I take the example of call holder has an expectation where price will go up.
Yes.
Just let's enter into it and see this. If the price go up, if I purchase at 405, and if the price means from this point, if let's assume it I have purchased it, and from this point if the option goes up, then I'll be in profit. And other side, let's say you are at option writing side, let's say you have written option against my call option, and if the price goes down, then automatically you would be in profit. Let's say you have already you have write the option in morning at 4, uh, let's say at 600, and now the current market price is 400. So it means see your profit 600 minus 400, around 200 for per unit. So unit into price, so that becomes your profit. And for option holder, what if that option becomes zero? Then entire my premium, whatever premium that I have paid, that becomes your profit. So it means whatever premium that I have paid, that would be my loss. As simple as that. And then see again same. If I want to sell the options, so it means here put normally why I'll sell it, because this option, why I'll sell this. If I sell it here, or days count, if I take it this way, price started from here, price goes up, the high price is, if you see this one, high point was 61, right? And now current is 49. In the morning you would have, let's say assume it, in morning you would have entered at this price 61
Yes.
through June 43800 P means put option. Then now you would have made a profit 61 minus 48, around 19
Yes.
19 points. 19 points into 19 points into total quantity. That becomes your profit. Why? Because price drops in the market. Price drops in the market. And that's what. So automatically you would be in profit. But here the logic works in a different way even. So price begin from here to reach here, it means you would have purchased here because it's a put option, and the price reached at this level, right? And if the price is coming down, it means your option that will automatically come in loss. This is a put option that works in a, it's a premium. Premium works in a another means different direction, right? If the price drops, premium goes up. If the price goes down, premium automatically that will go up in case of sell, right? So see, if you want to understand options, then you should try practically.
Yes.
Open the demat account, just try it with the small amount. So buy and sell and see how that works. That will help you to get the practical exposure. Otherwise, theoretically, from a even interview perspective, you may expect two to three questions. What if I invested in options and that options went in loss? So what would be my total loss? So my total loss would be my total premium, whatever that I have paid. And then who will get that profit? Who will get that then amount? Of course, option writer. So option writer will make the money, right? And if I earn money, let's say as an option holder, if I earn money, then option writer will pay that whatever money that I have earned. As simple as that, right? It's a zero sum game. So it means broker or other counterparts, they'll not bear anything. Or when you make money, also, they'll not pay anything to you. As simple as that. It's a zero sum game. Let's say in a game, you and I, we both are there. You make a money, so it means I have lose my money, right? And let's say I have make money, so it means definitely you lost money. That's what I have made it. It's simple process. It's not something difficult. It's a zero sum game. Options, you would see weekly expiry on a weekly basis. Options expires in the market. In India, we have C means call European, P means put European. So only the European options you would see that would be listed on a stock exchange, not American one. But there are two types, main two types I would say,
Yes.
American and European. And apart from that, there is one more type that is Bermudian. Bermudian, it's a combination of European and American. You would see
Yes.
both the features. And that's what those options which are not listed on a stock exchange. In India, only what you can do, you can buy or sell the European options. The reason is, see, the American here the European ones that will expire on a weekly basis. It means you can exercise on a weekly basis. So that becomes easy for a stock exchange also. And if you see any customized, so it means at any point in time, if you can exercise it, so that becomes difficult, right?
Got it.
So that's what here you would see European options, Europeans with weekly expiry. So you can exercise. The expiry would be weekly, but you can exercise again at any point in time if you want. So I can buy the options quickly, even I can sell it with the 2 points, 3 points, 4 points. But American, so that doesn't offer that feature, and that's what it becomes difficult. See, European banking, if you see, I'll tell you the one unique difference, not with the options only, but with the any business, I would say. The European options or European instruments or European investment strategies, always they protect the interest of investor. Always. But American, they don't. They always support to the capitalist. So it means they support the option writer. Once you entered in option, so you cannot exercise until the expiry. That's the feature of American. So now you tell me, if I enter in any option trades and if the price is, let's say, so my option is in profit and still I'm not able to exercise it. So that would be the loss eventually at the time of maturity automatically premium of that options, it will decline due to time. Anyways, that I'm going, I'll have to bear my losses. And that's the reason stock exchange that doesn't allow the American options on a stock exchange.
Got it.
That becomes risky. So yeah, that's all about options. So options you can buy means in the indices, in the stocks, even individual stocks also, that you can buy it if you want. Any reputed stock, let's say SBI, that you can do it. SBI future, SBI options, let's say 700, 700 P, 700 C, so that you can buy it. It's a strike price. So if you want to buy, you can buy it any options with the range of price that. So the current market price is SBI stock 5800. Okay, price drops significantly. I was expecting 700 price 600, but now drop it. So you can buy that option, any option that you want, right? And the major difference is, so if you see here, SBI, let's say 700, it's not 700 now, but 600 that you can think of. If you want to buy this one, 600 call option. see the amount that you required for per unit. That you required 11,175. So that's your premium, right?
Yes.
That you required. But if I check with same SBI 600, same option, if I look for a right option writing, see this 1,40,000. This is the difference. So you required then total amount. You required then total amount. So are you getting me? So it means that's the difference. So here for option writing, so you will have to pay full amount, not the premium. And that's the leverage you would see where the option buyer they receive, because they are just holding rights. And here the option writer is paying full of amount of that contract, because options it means it's a digital contracts. I'm paying entire amount of contract as option writer, and as option holder you are just paying the advance amount 10%, 20%. And so that advance amount we call it as option margin or option premium. But in a future we call it as a margin, and in an option we call it as a premium. But that works in a similar way.
Polish.
And
Again, like one scenario came across like where I don't have answer, but it is like so the scenario was like whenever we are on an option, say we have one option and in between the period of the option, so the underlying asset declares some dividend or something. So what happens like after the announcement, obviously my price of the underlying will come down. So what happened to my option, call option? Because my call option always admitting that price will go up because of the dividend and the price came down. So there like there is price has been happened for my option strike price and yeah strike price, or otherwise like any profit action is happened like a stock or something, uh, my price will also come down. Then what happened to my
so very nice question. Maybe on my YouTube videos I would have explained it sometime. So there are adjusting factors, okay? Adjusting factors. Stock split, bonus, stock dividend, rights, and cash dividend. Even any bankruptcy event, so return of capital or bonus, buyback. All events that affects on the stock price of that particular security. Are you getting me? All are adjusting factors. How that will adjust? I'll give you an example. Let's say first of all, ahead of stock, ahead of any event, let's say stock split, bonus, and rights. So stock exchange suspend the options trading for that particular stock. That's the first case. Suspend the event. But let's assume it already that particular contract is on, and meanwhile, so companies come up with the cash dividend. So in that case, stock exchange cannot suspend it, right? They cannot suspend it. Then let's assume it. So you have entered in the contract with this price, right? Price reached to this. You have entered here, and once you entered here, company announced dividend of 10. As I told, it's an adjustment factor. Then stock exchange automatically will adjust the 10 rupees. Right? Will adjust the 10 rupees. It means price will correct.
Yes.
Automatically, price will drop that security in the market. So price will work like this. Now it's touched to this. Here you entered in, let's say CE, call European, and automatically on the dividend date, price drops. And now the price of that option is 30. So if you see, if this happened, then automatically you would be in loss, right?
Yes.
40 minus 30, 10 rupees for per shares. But as I told, it's an adjusting factor. So it means stock exchange will adjust the price of option trades also proportionately. So directly option contracts will adjust by 10, or that affects, you can say it in a premium. So your premium also will, either the total premium which you have paid, right? Total premium which you have paid, where stock exchange will add 10 rupees there. So it means whatever law, so you paid premium, let's say you have paid premium 40. So we are assuming it, you have paid premium 40. But due to this, so you would see loss of 10. But stock exchange will add 10 rupees as a dividend in your premium while calculating. So that becomes 50. 50 minus 10, again you would be at 40. So your total premium which you can see in the books of your account, which is 50. So it means no loss, no profit. Because 10 rupees dividend that will be added in your account. That is the one way. Or else stock exchange can directly adjust the price of contract in the market. Adjust the price of a contract in the market. How? So directly reduce. If the price drops, the new price would be 30. So on the basis of 30, contract will reprice and then that will work in the market, not 40. So every means, so automatically whatever losses that would be, that stock exchange will remove it losses. The difference of dividend, that losses will adjust. And even the profit of that option holder, that will also adjust.
So, as per my understanding, it's like my strike price will be from 40 to 30.
Yes. There are two options, as I said. One, the dividend directly stock exchange will add in the holder, means call holder, right? Let's say you have a 10 rupees loss here in this contract, but you have received 10 rupees dividend as well. And dividend always received to the buyer, not the seller. Correct? You are the
Yes.
contract buyer and your underlying asset generated dividend. So it means as an option holder, you are entitled for a dividend. But so we cannot process the dividend for option trades, but we can assume it that the same asset generated revenue. So that is, it means that should receive to you, and that's the reason. So that will add in your account. Let's assume it there is a loss of 30. I'm assuming it there is a loss of 30, 10. That's absolutely fine. Take a loss as it is, but your total assets, you paid 40 and now you have a loss of 10 due to dividend. Net asset should be your 30, right?
Yes.
Add dividend. Why? Because dividend that generated on the underlying assets, and dividend will receive to the long holder, or the person who is holding the assets. That's the one rule. As per the corporate action rule, call holder would be entitled to receive the benefit of dividend, and that's what we are adjusting it. 30 plus 10. Again, he would or she would be at 40. So it means no loss, no profit. So dividend you can separately add it in the premium as a dividend, and that's become 40.
Yeah, let's
This
say like another scenario here. Like one is like if my conversion is gone wrong at the end of the option date, so my entire premium will be at loss. let's say like if I'm predicting it will go up, but it came down like completely down. So due to the time factor and expiry of the option, so I completely losing my premium. So then what happened to this 10?
See, ultimately, it's not something that due to your option expiry and all. It is just a matter of your corporate actions that affected on the price. That's what stock exchange adjusted the price. But due to the expiry and all, if that options become zero, then ultimately all your benefits will become zero. So you don't need to pay any extra amount, right? So only the whatever premium that you have paid, it's game of this premium only. So that will become zero.
Okay. On other hand, if I the price is going up, then I will be getting just someone. For example, my strike price was right now was 30 after the dividend. So again, it was moved to at the end of the rupees per share, and I will be getting as you said, like 100 to 10, 12 to some around 1,000 rupees. And what about this 10? Again, that benefit also will be lakhs or
No, it's not a benefit. Try to
5 lakhs.
understand it. It's see 10 rupees, it's not a benefit something as such. It's a just price the stock adjusted it. Right? Stock exchange that adjusted the price. It's an adjustment factor. Let's take it in other way around. So you have a stock split. Stock split. Right? 20, 40, 60, 80 price of a stock. Right? So here let's say assume it X date. That's a market graph. So here stock price of XYZ stock is 80. Right? GMT announced stock split. GMT announced stock split for one securities shareholder will receive two. So automatically, if the GMT announced stock split, then automatically your calculation would be 80 divided by 2, correct?
Yes.
So adjustment factor is this calculate, see ratio, this ratio would be your adjustment factor. Understand this,
Yes.
right? Then automatically in the market chart also, you would see the same. Go and check it market chart, directly price will drop. Straight away price will drop and that will reach at this. That means stock exchange adjusted the price of GMT stock in the market and automatically price will be considered from this point, not this point. So now your question would be, so how this will affect it on the stock option? Let's say there is one counterparty who signed this contract at 80, CE 80 and PE 80. The calculation is very interesting. Okay. So now you see if you have signed the contracts at 80, so it means automatically you would see minus 40 in the
Yes.
call option, and this guy would see plus 40
Yes.
because he got the benefit of corporate actions. But eventually that happened because of adjustment factor, and its adjustment factor is 1 is to 2, where stock exchange applied adjustment factor of corporate action, and that's what the security price drop in the market. The logic is very simple. If someone is earning 40 and if someone is losing 40 just because of due to pricing adjustment factor, so where stock exchange will automatically adjust the price of 40 plus 40 here and minus 40 here. Why? Because there is an adjustment factor of 40. New price of per security would be 40. So initially there was only one equity in the picture, one equity for 80, but now there are two equities with 40, so that becomes 80. And that's the reason here the stock exchange will add one more 40. So it means in the call option, let's say that that counterparty only purchased one for 80, right? After the stock split, that price become 40. So it means there would be loss of 40. Then stock exchange will add one more share. So that becomes 2. 2 into 40, 80. Right? Because post corporate action, one share value becomes 40, correct? Are you getting me? So one shares become 40, but that doesn't make any sense. The reason is the adjustment factor is 2. Add the 2 into 40, that becomes your total calculation 80. So in the lot itself, stock exchange can add one more quantity.
If I, for example, if I'm starting up the option, I might be have budget 1 lakh, that might be have 2 lakh.
Yes, two lot or maybe quantities you can see increase and decrease the quantity of shares. So where quantity can also increase and decrease. So there are things. So it means one you can see quantity wise adjustment, another you can say price wise adjustment. Or else directly stock exchange can add the benefits 40 here, 40 there. That's fine. So that depends on the stock exchange how they want to keep it. If they want to add it, see even in if you can increase and decrease the quantities, that is also fine. If you can increase the price of that particular options, increase and decrease the price, that is also fine. Or else if you want to credit the benefit of that corporate actions to the long holder, that is also fine. That doesn't affect the contracts or doesn't affect the obligations, whatever obligations it was signed, that doesn't affect. The impact would be neutral. Okay, but that say this is how the adjustment works. And the corporate actions which I told, so that all corporate actions affect rights, bonus, stock dividends, then buyback or return of capital, let's say redemptions and all. In a redemptions, let's assume it how this will affect. For example, the company announced redemption at here. If company announce redemption here, it means price of that security drops and that will come at 0. So it means delisting of securities, right?
Yeah.
Company want to delist the securities, and if the security price becomes 0, then automatically stock exchange will ask you to delist it. Okay. Any other question?
Yeah, actually, can give me single word of explanation or the shell, because I have a couple of other questions as well. Here, like, I have a question on private equity. Do we have a performance fee on private equity also, like this one?
In a private equity, instead performance fee, we charge it as a catch up,
Oh,
but which is equivalent to the performance fees.
yeah, yeah.
But that doesn't mean we don't charge the performance fees. So there are two types of funds. One is pure private equity funds, so which they invest into the core illiquid assets or LBU properties, right? And there would be other private equity with hedge funds. So it means nature of fund would be hybrid, which we call. So where they invest into swaps and plus illiquid instruments like ABS, MBS, or any rental properties. Yes. So in that case, you can charge it as incentive fees. So how that work, I'll brief about it quickly. Let's assume it. So this is the graph. price, let's say time. Investment start at 0, right? Or here you can say instead 0. The invested capital is 1 lakh. So invested capital, that becomes your initial investment, right? And you know it. So nobody pay the incentive fees on initial capital, right?
Yes.
No fees, no performance fees. No performance fees. Let's say here price becomes 1,20,000, 1,40,000, here let's assume it. In a private equity, what happened? Fund manager commits 10% preferred return. 10% preferred return. So every year that investment will receive 10% of preferred return. It means it's an interest payment. So where investor will receive accrued interest of 10% per annum. Simple. First year, second year, and third year. So let's assume that this particular investment value reached to 120 in first year. Second year it reached to the 140, and third year it reached to the and this is exit time. This is your exit time. Exit time. So every year, just calculate the value of investment. Calculate it. 1 lakh into 10 divided by 100. So 1 lakh 10.
10,000.
Right. 1 lakh. There are two ways. One is simple interest and another one is compounding interest. Means preferred interest where private equity fund offer in two ways. One is compounding and another way is simple. So we are here. Let's say we'll discuss about only simple. Simple, it means on a original amount interest will be calculated. So here total investment value would be, means from an investor perspective, 1 lakh 20, and here 1 lakh 30, and where redemption or distribution will be executed. In a hedge fund we call it as a redemption, but here we call it as a distribution. Distribution of what? Distribution of, here if you see, include P and I, right? P and I means principal and interest, correct? So here if the private equity execute distribution, first of all you need to pay principal and interest payment to the investors. So we are paying the same. So let's pay it then. So now at exit time, you have received proceeds of, because this is the market price of investment, current market price of investment.
You are actually
1 lakh 10. So this one is the initial investment, which is 1 lakh. Second point, 1,10,000 is your investment cost, I can say. So it means principal plus interest that you need to pay to the investor. Right? Principal plus interest, principal plus interest. And here, this one is the current market value of investment. As per the valuation, your valuation reached at every year valuation grown like this. Your 1 lakh become 1 lakh 20, 1 lakh 20 become 1 lakh 40, and 1 lakh 40 become 1 lakh 60. So at the time of, let's say, at the once the investment complete or mature, at the time of mature or at the time of redemption, so issuer company, let's say this investment was into the GMT company. So GMT company's valuation reached at 1 lakh 60,000, where GMT company process you 1 lakh 60 rupees cash. So in the books of private equity, you are an accountant and you have received 1 lakh 60. You have received 1 lakh 60 as a proceed. The language here would be proceed. Proceed is nothing but it's a sell of investment. In a hedge fund, what we do? So this become your purchase of investment and this become your sell of investment, right? We are doing the same thing here. Proceed, it means the proceeds which you have received when the fund sold that investment in the market. Simple. When you received 1 lakh 60, so you need to ensure the return of principal and interest to the investor, correct? And we are doing the same thing here. Then return it. Return it. You have two values, 1 lakh 60 and 1 lakh 30. 1 lakh 30 you need to first return to the investors, because this is the high watermark in private equity. High watermark is first high watermark, second high watermark. High watermark, it means principal or interest payment. If fund generate the returns more than this, then only private equity fund would be able to offer the incentive or catch up to the investors. See the calculation here also. If you see, the main actual cost of investment is 1 lakh 10, but the fund generated return 1 lakh 20. Here with the second case also, second year, if you see, total high watermark means 20,000 as the interest payment and 1 lakh is the initial investment that the fund made, but fund generated the return up to 1 lakh 40,000. Same if you see calculation here, fund reached at 160, means total investment reached at 160, but the high watermark which is at 1 lakh 30,000. So don't you think that here the incentive fees will be generated? Fees will be generated, right? And then how you can calculate the fees then? 1 lakh 60, your total investment paid.
So I have to pay first one time or the then my amount total it was 1 lakh.
Remaining proceeds.
Catch up, then if that's the catch up percentage.
So here you would see two things. Here you would see two things. On a remaining amount, you can pay 20% incentive fees if you want. That's the one case. Calculated if you want if you want to apply the incentive fees. So that becomes 600, 6,000, sorry, 6,000, right? So remaining balance should be, so this is becomes your incentive fee to the LP. Sorry, GP, general partners. Net investment. And here you can announce split. That becomes your carried interest. Carried interest. Yeah. So 20-80, you would see the ratio, means 80% to the investors and 20% to the general partners. So split that and apply it in the books of fund. And apply the same accounting treatment in the books of LP. you can record this one, and in the books of GP you can record this one. So this is how, as in a private equity, we apply the treatment in the books of fund. So here this process we call it as a distribution. So each and every investment we apply the same treatment. So we apply the schedule of investment. It means that represent the investment status, right? As I said, like investment status is very important. For each and every investment, we apply the same treatment. So initial investment 1 lakh at 10% per annum. So that is your preferred interest. Means which is the cost of investment that need to pay. And then every year see the price movement of your investment. See the movement. First year, second year, third year, and fourth year. Current market price of investment. Note down this. If you see any question as such, so you can, explain it very clearly. Don't mess things here and there. So first year investment reached at 120, 130, 140, and 160, 170. Price of investment. Let's say first year you have received redemption request from a same investor that a investor don't want to continue with the investment. So how will you execute the process? From an interview perspective, I'm asking question to you. So investor first of all committed that investor will be with us for 4 years. But after the completion of 1 year, you have received request that investor don't want to continue with your investment. So how will you execute the distribution then? So now tell me, as an accountant, what would be your course of action? So how will you execute this transaction in the books of account? How will you calculate the proceeds and all? Come on. So I've asked question to you. So investment was an investment for 4 years, right? Hello, I'm audible. So my question is to you, investor was in the investment for 4 years, but after 1 year, you received the notice from the investor that the investor don't want to continue with this investment. So here investor sent notice to you that investor don't want to continue with your investment. So how will you execute this process as an accountant?
Okay. First thing is like whatever we have policy,
Hmm. 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 So as of now, the market value means current market value is 1,20,000. Hmm.
So after procedures of the funds is already discussed in the big market. So realize that it will be giving the direction of such fixes penalty amount and
See, I'll simplify it. I'll simplify it. That's what I said. Like representation is important. I'll simplify it. First of all, the investor. Can you hear me? Hello. I'm audible, right? First of all, investor is not continuing with the investment. It means here penalty will come into picture. That's the one aspect that is there. I'm agree with it. I don't have any question. But from accounting perspective, you need to calculate the value of this investment first. Measure the value means measure the fair value of investment. Then check the investment cost. Investment cost, it means 10 into 10, so that becomes 10,000. 10,000 is the investment cost. Fair value is 1 lakh 20. All right. So you might see other expenses as well, broken deal expenses or promotion, marketing, all expenses. Calculate normal, all the expenses. Then third would be calculate all the expenses. Let's say that reached at 2000. So assume it. Fund will have two options. Fund can go in market and check for the other investor who is ready to invest at 1 lakh 20. That's what we calculate the fair value. Right? So fund manager will find the investor and will transfer 1 lakh 20 to that particular means other investor here. Let's say here A investor enter and he automatically after the sell B investor will come into picture where B investor will pay this 1 lakh 20 and that's what you have received fair value of 1 lakh 20 from the B investor. Then you can announce proceeds. Your proceeds should be like 120 you have received it. Return the capital of investor first. So that becomes 1 lakh. Then return the interest for 1 year. Sorry, 10,000. Remaining would be 20,000. Then return the interest. And remaining would be 10,000. And into this 10,000, you can also reduce the total expenses. So that becomes 8,000. And on 8,000, already fund achieved the high watermark, right? High watermark was the capital plus 10% interest. So it means high watermark, if you calculate here on the graph itself, that looks like this. So high watermark would be this. High watermark. Right? 1,10,000. That becomes your high watermark. And fund already achieved high watermark. So it means fund will charge 20% incentive fees on 8,000. So calculate it. So that becomes 400 if I'm not, 1600. Right? So 1600 that you need to pay to the general partners and remaining would be 6,400 that you can split. So this is how we calculate the proceeds in the private equity space. And this will apply to the real estate accounting as well. Okay, in real estate accounting, in a real estate accounting, so the important things are, see, here we are talking about real estate. Real estate, it means the investment vehicle or the instrument would be properties. So it can be even under construction and constructed properties. under construction properties, then open land, right? So it can be agricultural land or it can be commercial land, residential, agricultural, and commercial. Right? So here private equity can hold properties, lands, even sets as well, commercial sets, warehouse. So they can hold it. So now you think when you invest in equity, we receive dividend as the income or capital gain also that you would see. Then if you invest in bonds, interest payment factor come into picture. When you invest in money market instruments, again interest factor come into picture. But if you invest in real estate, automatically lease come into picture, rent come into picture, right?
Yes.
Capital gain come into picture. So you need to apply the accounting treatment, lease, rent, capital gain, capital gain. So you would see this lease, rent, capital gain. And you need to apply the accounting treatment to the lease as well as rent. So how you can apply the accounting treatment? So lease and rent you can treat as a income. You can treat as an income. And here you can create then receivables, income receivables, right? And whatever income that you receive, that you need to also distribute, correct? Because when the fund receive dividend, fund can utilize the dividend in two ways. One, fund can directly announce distribution of dividends to the fund investors. That's the one way. And other ways, fund can also announce that fund want to reinvest that whatever dividends received. The same way, income fund can invest in other properties. Otherwise, fund can announce distribution of income also.
Also, that has like yearly for
Sorry.
income.
Property income
Yeah.
distribution, yeah, in that way you can say it, PID, property income distribution. So where fund can announce PID, property income distributions to the investors. And capital gain, which is again normal. So it means fund purchase the property or land purchase at let's say acquire at 1,20,000 and now sell cost is 2 lakh. So 80,000 become your capital gain. So that also it needs to be distributed to the investors. Acquire cost and sell cost. So it means, see, if you talk about real estate, so these are the scenarios where we need to work on those and apply the accounting treatment in the application like ERD or Investran. Geneva is not the perfect for real estate accounting. So Geneva has limitations, and that's what Apex has an application like ERD where they maintain all the real estate investment business activities on ERD application. And even if you see that in their job description they have mentioned about ERD application,
Yes.
right? And if you see any question as around the ERD application, what it is and how it works, then you should highlight like ERD. It means it's an accounting platform where so that accounting platform helps real estate funds to maintain the accounting data or transactions for a real estate uh, product like the under construction properties or commercial properties, commercial spaces, sheds, warehouse, and all. So where the accountant can manage all the things in one place. It's not 100% that the RD help to the private equity, real estate private equity businesses, but somehow I would say because there is no advanced application developed yet. for a real estate private equity accounting, just because of pricing. The pricing of in a in a listed market, so you can easily get the pricing from the stock exchange, right? But how can I get the under construction project cost? Or how can I get the price of residential properties? Because prices which are not listed.
Yeah,
So,
even shares can have like most of the prices on the market. So we can say that it's an next day. But here you can't say that what was the value of the property which is under construction. So while it was starting the construction, it was starting the completion. So while it was the duration of the construction, it will be a different valuation. What is completed, that will be a different. But overall, like get the complete profit only after selling.
yes, that's what here most of the funds should be closed-end funds. The reason is closed-end funds. Once you invest, fund will be closed for 10 years, 20 years. Means after come, let's say at the time of under construction, we have invested it. But investment will be executed after the construction, fully construction of the fund, that business. Okay.
Like I have another question.